Hello, I'm Damon Lane. Thank you for taking the time to listen to this short video. You know, in my workshops, I always ask my audience this question: who of you knows how to lose weight? 60 years ago, science came to the conclusion that it was mostly a matter of eating less and moving more. But after a few decades, people lost interest in that same bland message that works so well for losing weight. So marketers started to add to this simple formula of fads, tricks, and anything with a twist, so the consumer would be interested in their books, magazines, and exercise equipment. But as you read between the lines of that information, it's still the same formula that works if you want to lose weight. Eat less and move more. In the same fashion, economists and investment researchers found the formula for getting the highest returns in a very consistent manner way back in the 1950s. And it's rather simple. Own the markets overall in each asset class, broadly diversify, own quality, and rebalance when necessary, and pay low costs when investing. But like the diet industry, the financial industry, in order to attract investors, market new twists, fads, and gimmicks all the time to keep the investing public thinking that they, the experts, have new and better ways to invest. But in reality, it simply keeps their very profitable methods in place, earning them billions and keeping you, the investor, from what works best. You see, proper investing is very low cost for you if you avoid all their commissions and simply apply the knowledge that has been around for decades. Every investor knows that if they could see into the future with a crystal ball, investing would be a breeze and returns would soar into the stratosphere. The traditional investing industry wants you to think they have that crystal ball. Common sense aside, historical facts alone reveal that no one except God Himself knows the future. And navigating the rough seas of equity markets while relying on inconsistent opinions about what may or may not happen tomorrow is very risky business for you. But what if there were a method of building portfolios that had a very powerful advantage that we could employ to become successful investors? Well, I know that there is such a method, and investors have been using it for well longer than the 30 years that I've been in this business. So let me ask you another question. If there was a pill that could help people lose weight successfully and safely, but only cost pennies to buy, how motivated do you think the multi-billion-dollar weight loss industry and pharmaceutical companies would be to tell us about it? Maybe not so motivated, huh? Well, if a portfolio can be structured, and it can, in a way that incorporates low trading volume, holds asset classes that mimic total economies, and does not rely on market timing, guessing, constant trading, high fees, and commissions, could it be that pill investors are looking for? Unfortunately, such an approach is not very attractive to the Wall Street crowd, as their incomes would be greatly affected by using such a model. Our strategy is based on a philosophy that wise investing must rely on certain disciplines that create positive outcomes in any and every economic cycle, whether the markets are going up or down, while the opposite, traditional investing philosophies, rely on market timing, guessing, picking stocks that look hot today, or following current trends that continuously change. It's complicated, dangerous, and very dependent on unknown circumstances. Did you get that? The traditional investing relies on unknown circumstances. It's no better than going to the casino. We teach our clients never to place bets on their serious must-have money that is meant to support their life in the future. All of us need to develop a portfolio that is designed to do well in any economic cycle, meaning it does well when the markets are up and when the markets are down. An economy-driven portfolio is structured so that it survives down cycles by replicating market sectors and industries that represent total economic activity that always rebounds on up economic cycles, thereby recouping any negative returns when the markets rise. In many cases, this is not true with the traditional investing models that are heavily promoted by marketing messages on television, magazines, newsletters, and by stockbrokers. Please remember, in any attempt to develop a sustainable investing philosophy, an investor must be able to separate themselves from mixed messages, primarily those marketing messages that promote speculation over common sense. I go into a more in-depth explanation of this investing model in 2 of the chapters in my book. Give me a call for a free personal strategy session, either over the phone or in person, and I will be happy to give you a free copy of my book. And by the way, the strategy session is at no cost to you also. And don't forget to sign up for our free educational newsletter on my website. I want to thank you very much for taking the time to listen.